Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvily, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being, and most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Welcome to episode 363 of the Independent Advisors Podcast. On today's show, we're covering a few timely and important topics, including what a lost decade could mean for retirees' portfolios, how this bull market stacks up against previous bull markets, S&P 500 revenue growth, and comparing U.S. and global stock valuations. Whether you're tuning in for market insights, planning tips, or just staying informed, there's something here for you. So welcome back, Matt.
How you doing, Mark?
Good.
Nice to be back in the saddle with you, buddy.
Yeah, it is. School starting for your kids.
It is.
So you were out a little bit at the end of last week. Weather's been wild here in Dayton, Ohio. It's been raining, it feels like, for 5 days straight.
It's been wild.
So, just some weird stuff going on right now.
We took the kids to Cedar Point, their last hurrah right before school, Mark, and an interesting development happened at the Jessup household. So usually we do 3 straight days of Cedar Point, and anyone who's in the know with amusement parks, it is widely considered the roller coaster capital of the world, right? So usually by day 3, my 44-year-old body is barking, right? So what occurred on this trip is my kids started getting into fishing. And on day 3, the Cedar Point plans got completely scrapped, and the kids spent all day fishing. It was quite a development in the Jessup household.
Yeah, that's impressive. I've been hearing that a lot lately with kids, or at least friends that we have and that have kids around your kids' age are really into fishing right now.
They really are.
So it's like making a comeback.
It's very intriguing.
Yeah.
So more to come. Wanted to share that development with you.
Interesting. Well, yeah, happy back to school for the Jessup household. I'm sure it was pretty somber. Couple of days leading up to it.
The mood in the house this week, Mark, was very different.
I'm dreading those days over the next couple of years as they start to come.
Very different.
Yeah.
Very different.
As always, we will review the month-to-date and year-to-date performance of the major market indices that investors track. This data is from Y-Charts and as of the market close on August 12th. S&P 500 index up 1.9% so far this month and up 13.2% on the year. The NASDAQ Composite Index up 2.6% for the month and 14.4% for the year. The Dow Jones Industrial Average up 1.1% for the month and 11.8% for the year. The Russell 2000 Small Cap Index 2.1% for the month and 22.7% for the year. And the Vanguard All World ex-US Fund up 2.8% in August and 16.3% for the year. 2-year Treasury yield at 4.17%, the 10-year at 4.67%, and the 30-year yield at 5.23%. So not really too much in terms of big headlines, current events over the past week. I would say it's been relatively quiet. Earnings season still rolling on, but the news cycle is getting slower and slower as most of the large tech companies have already reported so far this year.
Before we get into this week's show, listeners, if you've been enjoying the Independent Advisors Podcast, I'd encourage you to head to our website, jessupwealthmanagement.com. I offer a 15-minute initial call where you can discuss your financial goals and see if JWM is a good fit for your needs. Scheduling is easy. Once you land at the jessupwealthmanagement.com website, just click Schedule Initial Call and select a time that works best for you. There's a quick survey to fill out that will help guide the conversation and ensure your time is used efficiently. If you're ready to learn more, visit jessupwealthmanagement.com and book your call today. I find it interesting
this quarter.
I find it interesting, Mark, that the last time I was on the podcast, there was all this doom and gloom in the market. It's just been 2 weeks, by the way. So 2 weeks ago, no one liked stocks. They were concerned about earnings. Inflation was rampant in everyone's mind. They were concerned about geopolitical headlines. Then we fast forward 2 weeks, and a lot of those concerns have been brushed aside. And it's just a good reminder for listeners that you want to talk about the pendulum swinging from the two guiding emotions of investing, of fear and greed. The last 2 weeks is your prototypical example. I mean, it's just perfectly thrown out there. And I'm going to call it. In the short term, at some point, we will get excess enthusiasm, and the pendulum will swing that far the other way. It's a good example for investors not to get caught up in these day-to-day headlines and really focus on your long-term goals. Otherwise, you'll drive yourself crazy.
Yeah, and you can already kind of see that. I mean, the market definitely seems like it is less sensitive to geopolitical updates and news. I think there was earlier this week, there was a ship that tried to get past the U.S. Navy blockade, and the U.S. fired upon it, and there was virtually no effect.
Yeah, zero.
On the market
no
anymore,
reaction,
right? Whereas earlier this year in March, that probably would have had a larger effect, and we've seen that over the past couple of months. Is that each thing that is going on over with Iran and the U.S. and Israel, the market just seems to care less and less.
It becomes desensitized.
Yeah.
Kind of like with tariffs, right? You go back to 2025, market was reacting to every tariff headline in February, March, and April. And as the year went on, just became more and more desensitized to it. And it feels like that's the trajectory we're headed, even if it's a prolonged conflict.
Yeah, and there's been updates with tariffs this year, and just recently, I think it was on Canada or something, and again, no reaction from the market. So yeah, just find that interesting.
Yeah.
Well, moving on to articles and research from this week. The first thing I had was a post on X from Ryan Dietrich on August 4th. This chart will be up in the YouTube page and on the show notes. But Ryan says this bull market is up 115%. Here are the 5 other bull markets going back 50 years that made it to at least their 3rd birthday. As we've been saying for years now, bull markets tend to go much further and last longer than you'd expect. This one isn't any different. So what this chart shows for maybe people that are just listening to this show is bull markets the past 50 years that made it past their 3rd birthday. And for the purposes of this conversation, a bull market begins when the S&P 500 rises 20% from any low.
Correct.
Okay?
Correct.
Bull market ends when it falls 20% from any market
high water mark,
right? Mm-hmm. So there were several instances, including this bull market, which started in October of 22 up until now. So you had October of 1974 through November of 1980. August of 82 through August of 87, December of 87 through March of 2000, October 02 to October 07, March 2009 to February of 2020. So, when the market makes it past year 3, it tends to go on for several more years. Not saying that that's going to happen in this instance, but when you're comparing it to the average over the past several decades, I think this is another piece of data that is probably in the bull's favor. Not saying that we can't have larger pullbacks of 10, 15, or close to 20% between now and whenever this bull market ends. But I think Carson and Ryan specifically has been banging this drum for a long time that, even when people are like, we're in a bubble, this bull market can't go any higher, blah, 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 blah. Mm-hmm. He brings out data like this that just completely contradicts the mainstream narrative out there.
Well said, Mark. Good piece, by the way. 2 thoughts come to mind. First is the average length of a bull market that gets to year 3, I want to say is like around 5.5 years or so. So that's kind of what the average is. Again, like you said, it's not guaranteed. Secondly, look at that run from March of 09 to February 2020. There
It's a long
was
time.
a lot of things that happened along that road that scared a lot of investors. And I think a lot of people hear this and, we'll get a couple decades down the road and we'll show something similar. And I think investors will look back and go, oh, that looks like that was probably a cakewalk. And it's not. The average intra-year correction for the S&P 500 dating back to 1950 is 14.6%. So in any given year, from a high watermark to a sell-off, the average investor is going to experience a double-digit correction during the year. That is part of the price you pay for these longer-term rates of return. And I think what happens, Mark, is we go through these periods or bouts of lower volatility. People become trained. Oh, this is great. These returns are great. And then you get a 10 to 15% correction and the world's ending. And the reason we talk about it so much is we want to let people know that, guess what? That's normal. That is normal, and we need to get that out there more and more often. Great piece, though.
Yeah, it was good timing to kind of talk about that too, because as we head into, we already are halfway about through August and into September. Again, these tend to be the 2 weakest months out of the year, especially in a midterm year. So
great point, Mark.
We've had a couple of weeks where the market has done really well. August has gotten off to a hot start, but again, it wouldn't surprise us if volatility picks up a little bit here and lasts through the majority of September, just because that's what we've seen in the past. So that shouldn't be surprising to people. And like you said, we could get a larger pullback of 10 to 15% between now and the midterms. It's very possible.
We get to the midterms and if we are at the numbers then that we're at today, I'd be ecstatic.
Yeah, me too. Second thing I had was a post on X from Jay Capel on July 21st. So Jay is someone who works at Sentiment Trader, who puts out a lot of good research. He says tech insiders have been heavy buyers as of late. Still, should we be surprised if tech struggles in the month ahead? History suggests no, we should not. So we have kind of an interesting thing going on right now, Matt, where, these graphs that Jay shared, tech insiders are extremely bullish right now, or at least they were in mid to late July. And you have these executives at tech companies buying their own stock, and we're going into a period of the year, kind of already in that period, where technology stock seasonality is the weakest part of the entire year, right?
Yep.
So I know that, these insiders are very long-term, right?
Correct.
And they're going to have a bullish bias to their stock. But
Correct.
Typically when you see insiders putting their own money to work in their company's stock, and you see this across the entire industry, it typically tends to be a good thing for future returns for that sector or industry, whatever you're talking about. And maybe, the next couple of months is going to be used as another period of buying for these people. But I just thought it was interesting, given where we are in the calendar, that we tend to see weakness in tech, but we still have these tech executives, buying a lot of their own company stock.
Well said, Mark. And one thing you've always said in the podcast for many years is there's a lot of reasons why insiders and executives sell their company stock, but there's only one reason why they buy it. I think it's going to go up.
Right.
And I saw a similar data piece to this, and going back for our podcast listeners right now listening to this, back to like 2010, that was the highest singular month of insider buying of technology executives in over 15 years. I don't know. That's a pretty bullish stat. I'm sorry.
Right. That doesn't sound negative to me, and it doesn't sound like bubble talk to me for the people that work at some of these smartest companies in the world.
We're not buying it for charity, I'll tell you that.
Right. So, last thing I had was a post on X from Charlie Bilello. This was on August 11th, so earlier this week. Charlie says there are now over 1.1 million homes for sale in the U.S., the highest inventory since 2019. So we've talked about this, I think, a couple of times over the previous few weeks, Matt, but we are starting to see inventory start to grow in a lot of these popular, I would say, states that people have been moving to over the past several years. I think we used Florida as an example several times, but maybe this starts to put some downward pressure on housing. But we've also mentioned that, interest rates continue to go up. I think the mortgage rate, I think I talked about this last week when you were out, the average mortgage rate was at its highest level in over a year last week, right?
Yeah.
So it's going to be really interesting to see how this stuff plays out, and I've been, reading on X and other news sources, and there's already people calling for a housing crisis. It's going to be worse than 2008. And, how many times have we heard that since 2008? A lot. Usually once a year I see it.
Yeah.
But just thought it was interesting. So if you are out there on the market, you could start to see some lower prices coming with the amount of inventory there is.
Yeah, I definitely think you're seeing some more poor data in the states that are popular for second homes. So I want you to think of the likes of like Florida and Texas. Definitely are seeing in certain parts of those states, let's just call it weaker housing data, a lot more inventory, price cuts. I'm seeing that type of data. The comfort that I have on this topic is there's been some pretty tight lending standards the past decade plus. So this is not a mid-2000s issue where, people were buying homes that in essence didn't have the incomes at the time they bought it. So I think that it's not completely comparable, but my opinion on this topic is it's going to get worse before it gets better.
Meaning what?
I think that you're going to see more inventory hit the market, more price cuts for people that need to sell. You had a lot of people who were doing investments. It was looking great, like an Airbnb, and all of a sudden the underlying property value is turning against you. Oh, I just got to dump this and move on. This is a bad idea. I don't like being a landlord. I just feel that, this is kind of ripe for, if rates come down quicker, I could be wrong. I just have a feeling that, if you're in the market for a house, you might get some pretty good buys coming up over the next year or two.
Yeah, which is something we haven't seen in a very long period of time. So definitely if you're, someone looking to buy, you could get some pretty cheap prices compared to what you could have gotten over the past several years because, I think there was this huge boom after COVID where it seemed like everyone and their mother were buying like properties to do Airbnbs or VRBOs or rentals. And, I'm seeing a lot of stuff out there that a lot of people are starting to be underwater on those properties now. Cause it seemed like at one point that they couldn't, you couldn't lose money with the way the housing market was going, right?
Yeah. I feel like it was last year, it was a year ago. I got this influx of calls of individuals who were utilizing Airbnbs and it was in the state of Florida. And I felt as if it all happened at once where these investors were like, I got to get out of these things. And they were just dumping their Airbnbs last year. It just, again, one instance doesn't make a trend, but it was interesting seeing that last year. One more thought I want to throw out there kind of on the housing front. I think it will be interesting, Mark. Interest rates are going to be the thing that saves it or makes it worse, in my opinion, like you mentioned earlier. So watching rates is going to be very key.
And I think there's about a 50% chance that the Fed hikes in September right now.
Guess what? The economy's not doing bad. I wouldn't be surprised.
Right. So anyways, I'll turn it over to you. We wanted to take a minute and tell you about a service we personally use and trust, LifeLock by Norton. With everything we do online these days, protecting your identity and personal information is more important than ever. That's why we've partnered with LifeLock, a leader in the identity theft protection industry. Their mission is to empower people to live their digital lives safely, offering tools to help protect you and your family from threats like identity theft, cybercrime, and fraud. They combine advanced technology with 24/7 support to keep your information safer in today's connected world. We use it ourselves, and we think it's a valuable tool for anyone looking to add an extra layer of protection. If you're interested in checking it out, you can use our special link to get a discounted rate. As a heads up, we do receive a percentage of compensation if you sign up using our link, but we partnered with LifeLock because we believe in what they offer. To learn more and get the deal, just head to jessupwealthmanagement.com/LifeLock.
All right, my first piece has to do with S&P revenue growth. So if you are out there right now and you're wondering, hey, why are stocks doing well right now? This is one of the key reasons why. Underneath the surface, fundamentals for a lot of companies aren't just good. I would argue for a lot of them, they're great. So this chart is from Charlie Bolello on August 9th, and I will verbalize this for our traditional podcast listeners. Mary Beth and Jenna will put this up for our YouTube viewers. What it illustrates, Mark, is S&P 500 revenue growth for the same quarter year over year. And when this was timestamped on August 9th, 88% of companies reported for Q2. And what it's illustrating is that from the second quarter of 2025 compared to the second quarter of this year, S&P revenue growth is up 15%. Massive, massive top-line number. To give you an idea, in Q1, the year-over-year number was 11.8, and then in Q4 of last year was 9.4. So you are seeing top line. This is not net profits. This is sales. This is a top line number growing at double digits. That's pretty impressive.
Yeah, it is. And this is, I say this a lot. This is another chart that just makes sense to me, right? So, since this chart shows revenue growth in the S&P 500 from December of 2021 up until this point now, the weakest year-over-year growth was in 2023. So June 23, September 23, December 23. And what happened in 2022? It was the worst year for stocks since, was it the GFC?
I very much dislike 2022.
Yeah, it was a bad year.
Very much dislike that year.
What do we know about markets? They're forward-looking,
That's
right?
right.
So the weakness in 2022, anticipating the fundamental weakness that we were going to see show up in these earnings report in 2023.
Yep.
And then what happened after that? It got a lot better. And what
did.
happened since 2022? Stocks have been doing great.
Yes.
So, this isn't something that should be surprising to people. It's not, looking at a chart of revenue growth and earnings growth for the S&P 500 isn't going to tell you everything you need to know about making investment decisions, but usually it does a pretty good job of making sense why things are going the way they are.
Exactly. Underneath the surface, the fundamentals of companies, like I said, in a lot of cases, not just good. Some of them are great. So my next piece, Mark, I'll be a little quicker on this one, but this has to do with the balances of money markets from bar charts on August 5th. 8.3 trillion is now sitting in money markets, an all-time high. Again, Mary Beth and Jen will put this illustration up for our YouTube viewers. I'm verbalizing it for our traditional podcast listeners. A year ago, it was $1 trillion less than that. So even though stocks are at or near an all-time high, you also have an all-time high amount of cash on the sidelines. Now, if I had a person who was bearish on the market sitting next to me, here's what I think he or she would say to me. Matt, the reason money markets are as high as they are is no one likes the bond market right now. So it's the place where people are parking money. So be it. Guess what? Bonds aren't doing the best right now. So all of a sudden, stocks are the competition, and there's a lot of cash sitting there. And if you get any sort of correction, that money has the ability to come off the sidelines. So you got to have dry powder, and the dry powder that's on the sidelines is immense right now. So no one can look at me and say, Matt, there's no money to bid the market higher. That's a false statement.
So I want to challenge you to do something to have some data on the next podcast episode.
Go ahead.
I would like to see this number. Can you guess what I'm about to say?
No, I don't actually.
Relative to household income or net worth or something, right? Because I feel like this is just one of those metrics that I want to see it, relative to something. It's kind of like what we always talk about when, we get that once or twice per year news article that pops out that credit card debt's at an all-time high or household debt's at an all-time high. And we're always sitting there saying, hey, we should see this relative to household income.
Yep.
So I'd be interested to see if you could finagle some data together to get this, again, I think relative to household income or relative to household net worth, I think would be interesting to see over time.
I think what I would like to attack is a year ago, I had this piece about the average American household and what percentage of their net worth was just sitting in cash. And there's been, at least as of a year ago, there was this demographic shift to where pre-COVID cash levels of the average household net worth, it was like sub 2%. In the data as of a year ago was massive. It was like 6%. And I also think there's been this psychological change that's happened with society. I feel that because of the COVID era, you now have a society that's like, I better have some reserves. And I think that's also been part of this shift.
Yeah.
I'll see what I can dig up.
Yeah.
All right. My next piece has to do with what you previewed at the top of the podcast, Mark. It has to do with American stocks represented in this piece of the S&P 500 and what their premium is in general compared to global equities. Now, before I go into this, it's no secret that historically, U.S. stocks tend to trade at a higher valuation, meaning people are paying more for those earnings compared to a lot of stocks outside the U.S. And historically, some of the reasons for that could be things such as better balance sheets, better growth rates. There's reasons why this tends to happen. So this piece caught my eye from the Kobayashi letter, and the date on this, Mark, let me get this right. It was over the past week. So what you're going to see here is, this is what they said. U.S. stocks are cheap despite trading at all-time highs. The S&P 500's forward PE premium relative to global equities is down to 22%. That's the lowest since 2020. This marks a significant decline from 50% seen in Q2 of 2024. This is also in line with levels seen in 2018, 2019, and below the 10-year average of a premium of 31%. The piece goes on to say this comes as U.S. earnings are proving exceptionally strong, with the S&P 500 profits currently tracking 28.7% year-over-year growth. By comparison, European companies' earnings growth is on track for 14.4% year-over-year, half of U.S. levels. Many U.S. stocks are getting cheaper as they go up. So this illustration will again be put up by Mary Beth and Jenna for our YouTube viewers. We'll have this in our show notes and all of our social media sites. You can go to Jessup Wealth Management. You'll see these charts. But what I'm verbalizing is the rise underneath the surface of earnings growth has been impressive. And there are actually companies out there on a valuation basis, Mark, that are cheaper today, even though their stock prices are higher than they were last October. It's just amazing.
Yeah, and I think another thing that's important to point out, too, is, again, I'm going to say it once, if not a million times, but this is another piece of data that makes sense to me because the U.S., it's no secret that the U.S. markets are dominated by technology companies, right?
Correct.
It's not the same for global or international companies, especially in Europe, right? Yep. Europe's dominated by industrials and financials and more value-oriented areas of the market. So it makes sense that the U.S. deserves a premium because they have the growthier names, right?
Yeah.
So, this is an interesting way, I would say, to look at valuation comparisons that we don't normally see.
I have a bonus piece for you this week.
Okay.
My bonus piece has to do with household wage growth. There was a post by our friend Mike Zaccardi of the podcast on August 11th. He said, and I quote, "The K is collapsing in July." So there's this theory of what we call a K economy, which is where people kind of focus on the upper class and lower class of society. In July, after-tax wage growth for lower-income households surpassed that of higher-income households for the first time since December 2024. And what this illustration is showing is that for year over year, for lower-income households, they exhibited wage growth of over 5%. And the top 5% of American households were sub 5. I found that really interesting because I haven't seen a lot of data that's shown a dramatic pickup in wage growth, especially for lower income households. This one stuck out at me. What's your thoughts?
Yeah, it's interesting. It's actually, it's this chart classifies income by 4 different categories: lower, middle, higher, and then the top 5%, and higher excludes the top 5%. The lower, middle, and higher all have been on the rise, as you can see.
They have.
And the top 5% is the only one that, really year to date, it looks like has been on the downfall, significant downfall, actually, from, 10% at the beginning of the year to less than 5% now. So
I think this is welcomed because let's face reality. The lower income households have definitely been pinched by inflation, the last several years, especially earlier in this decade. And when I saw this, I'm like, okay, this is welcome news for me.
Yeah, it's great. It's great. Good topic. Last thing that we have to discuss this week is the financial planning topic of the week. So this was from an article on Morningstar written by Amy Arnott, who is a CFA, on June 30th. So I came across this article that discusses a topic that I think keeps a lot of retirees up at night.
Okay.
And that is the fear of a so-called lost decade in the stock market. And when we say lost decade, we mean a stretch of about 10 years where the stock market goes nowhere or returns are actually down for a 10-year period of time, right? And this is important for retirees because most are drawing on their portfolio when they retire, right? So, this is one of the big things that at least I get when I'm in client meetings or prospect meetings is, hey, I'm scared that once I retire, we're going to go through this prolonged downturn period where I need money from my portfolio, but it's not going to be making anything, right? So I think the good news for this is that lost decades are very rare, right? So if we go back all the way to 1925, there's only been 2 major stretches where stocks lost money over a rolling 10-year window. That was the Great Depression and the 2000s, where you had the tech crash early on in the 2000s, then obviously the financial crisis in 2008. But outside of those instances, the odds are strongly in investors' favor over the long term. So Amy kind of outlines a couple practical things that people can do if this is a major concern of theirs. So she says, first, be realistic about how much you pull out of your retirement accounts each year. A popular question is, stocks average over 10% a year. Why can't I just withdraw 7 or 8%? The problem is averages hide a lot, like we talked about before. Any given decade can come in way below that, and an aggressive withdrawal rate in a weak market can drain your portfolio fast. Second, a balanced portfolio with a healthy chunk in quality bonds, cash, or alternatives gives you a cushion when stocks are struggling. And third, a bucket strategy. The idea is simple. Keep a year or 2 of spending in cash, another several years in safe bonds, and the rest in stocks. That way, if the market drops, you spend more from your cash and bonds instead of selling stocks at the worst possible time. So I think the moral of the story is, yes, this is a risk out there. Yes, it's very rare. And we're definitely at some point going to see another lost decade in the future.
It's only a matter of time mathematically.
We just don't know when that's coming or how long it's going to last, right? But I think this piece is really important, that trying to time a lost decade by sitting in cash usually backfires pretty hard, right? Because the market goes up more often than it goes down. On average, approximately 3 out of every 4 years, the market's up. So it's not a situation where I or you would recommend someone just keep 95% of their portfolio in cash because this is a concern of theirs, right? We're talking about something that happens about 4 or a little less than 4% of the time, which is not very often.
Great piece, Mark. It makes me think of a client case and a topic that's come up for me in our practice over the past week. So I've had a client reach out to me who's considering a housing change, okay? And a part of this topic is when they make this move, they'll need to take a substantial withdrawal from their portfolio because they want to pay cash for the difference in equity of their current home. So for this specific household, it would make up about 25% of their portfolio. Well, what's happened is over the past, let's just call it 5-6 years, despite 2022, this household's portfolio has done exceptionally well. And along that time period, they have taken excess withdrawals above 5% every year because the account's done so well. So when the clients reached out to me and said, if we consider taking this withdrawal to get the home we really want, our forever home for the rest of our retirement, how is that going to affect our ability for withdrawals? So I separated it 2 ways. I separated what they're systematically taking every year for their living expenses, and then I showed them on top of it how much that they are taking in excess withdrawals because of these outsized returns for really good travel. And the whole conversation that we've been having the last decade is they want to travel while they're healthy. They don't want to get to their really elderly age when their body's broken down and they can't travel. So when I told them their affordability, if they took 25% of the portfolio, what the 5% withdrawal would mean, I got an email back from this household that says, wow, that's a lot less than we expected. And I had to point out to them, yes, because when we're looking at a long-term commitment, we have to look at a realistic withdrawal rate. Now, if you continue to have excess or outsized returns, you would have the ability to do those other things. But when we're making these long-term commitments, not just what we make this year, what's a little excess I can take, you have to be conservative about that. And when I see things like this, it makes me think of that I think a lot of people when they retire, Mark, I think it's one thing to focus on what are your living expenses, but I think it's very normal for a retiree to enter these periods where they have deferred maintenance, right? At some point, you're going to need a new car. At some point, you're going to need a new roof. Like, go down the list. And you have to be strategic in those outsized return years on either tackling the deferred maintenance in your life, doing the trips on those special life events like special anniversaries or special birthdays. But when you're making these long-term decisions, you need to be realistic about a withdrawal rate because not everything is going to look like returns they have the last couple of years. That's my point.
Yeah, no, great added color to that. But yeah, it's everything in our world is, interconnected, right? So if you're worried about a lost decade, but at the same time you're taking 10% portfolio withdrawals every year, it's like you can't have your cake and eat it too, right? Mm-hmm. And that's why we're here, to help guide people through those decisions or give them things to think about that they might not necessarily be thinking about on their own.
Absolutely.
So,
this is a good podcast, Mark.
Yeah, I
missed
it
you,
was.
buddy.
Yeah, I missed you too. Hopefully we can get on a more regular schedule going forward. Anything else before we leave it there for the week?
Only thing that comes to mind is next Fed meeting is the middle of September, right? So that'll get a lot of headlines. And then not a recommendation for or against, but the tech bellwether NVIDIA reports, I believe, in 2 weeks. there'll be a lot of eyes on that name because of the health and where we stand with the semiconductor sector of tech. So 2 thoughts that come to mind.
Great. Well, thanks for listening, everyone, to episode 363 of the Independent Advisors Podcast. Catch us next week for episode 364.
Take care, everyone.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Facebook, Twitter, LinkedIn, and X. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved.